Good afternoon, folks. You're very welcome to the Cork Society of Chartered Accountants webinar series for the month of January. People are just joining us here now, so I'll just sort of briefly do some introductions before we actually kick off. My name is David Swinburne, and I'm a committee member of the Cork Society, and I'm delighted to be your host for this afternoon. I'm delighted that so many people have signed up and are joining us, as I can see, as they're coming into the meeting room. So you're all very welcome. It's the 25th of January. We're almost there through the month of January. It can be always challenging in lots of different ways for us, but we're getting there. There's a bit of a spring in the step. I actually had to close the blind down a little bit because the sun was shining in. So you're all very welcome. Over the last couple of weeks and next week and the week after too, we're running these series looking at topics from financial planning we had last week. We have mortgages today. Next week, we're getting some legal considerations to be looked at, and then the following week, we have health insurance. So I'm absolutely delighted today to introduce you to our speaker who's going to talk to us about mortgages. A lot of you are probably very familiar as to who he is and may know him, but if you don't, I will give him a brief introduction. So our guest speaker this afternoon is Joey Sheahan, and he's going to talk all things mortgages. Joey has over 20 years experience in the property and financial services industry here in Ireland, and he's provided thousands of people with mortgages, property, life insurance and pension advice and other financial services, and has been involved in over €1 billion over the past 2 decades in these sectors. Joey is very much a self-starter and has a strong appetite for commerce. Following 5 years working as an auctioneer himself, so property's in the blood, he founded MyMortgages in 2005, and it has gone from strength to strength over the last 20 or 17 years since then. Navigating some tricky economic waters during that time in the property sector and emerging as one of Ireland's most respected and renowned mortgage brokers with a national presence, so not only here in Cork and Munster, but indeed nationally. Joey has a good instinct for business and a natural rapport with people, and people that know him will know that is true, and he attributes heavily to his achievements over the year. He's a great advocate for charities and community work and initiatives, and is a willing participant in fundraisers, which range from 5K runs to marathons and triathlons and open water swimming. Back in the day, he was also a seasoned rugby player, and one of his key highlights was winning the 1998 Under-19 Rugby World Cup with Ireland. So the accountants will probably start now working out what age you are, Joey, but maybe you might want to share that with us later too. So Joey, I suppose, attributes the playing on the field to helping him to grow MyMortgages towards at today, and he's very much a team player and very much focuses on leadership. So with that introduction, I'm delighted to hand over to you, Joey, to tell us and talk to us all about mortgages.
Thanks very much, Dave, for that introduction. I'm not sure if I believe half of it, to be honest, but and thanks to Fiona as well for organising this event today. And I'm honoured to be speaking to the Chartered Accountants of Cork, and I'm delighted to be here. So I've got a slideshow I'm just going to go through, and I suppose if there's any questions, Dave will maybe ask them at the end. And so anybody, if there's anything unclear, or if there's anything people want to ask me, they can feel free to contact me after this event. We also have, I wrote a book called The Mortgage Coach, and anybody on here that wants a complimentary copy, if you just email info@MyMortgages.ie with your name and address, we can get you a copy to you complimentary for members of the Cork Chartered Accountants. So, okay, so I'll begin the slideshow here now. So just the first slide there. So again, thanks for having me on. So just housekeeping, questions can be submitted during the webinar by clicking on the Q&A button and type your question. The webinar is being recorded, so anyone who'd like a copy of it can get it afterwards. The slides will also be made available afterwards. That's me, the presenter. So just a couple of questions just to kind of get some scenarios. So the ECB has increased interest rates by 2.5% from 0 to 2.5 in 2022. How do you see this shift impacting the mortgage market as a whole? And on current homeowners and aspiring homeowners in the years to come. So yeah, it's no secret that rates have increased and probably will continue to increase further. My guess is they might end up maybe somewhere around 4%, which means borrowers might end up paying maybe around 5%. So obviously higher rates means, higher repayments. So if you have a mortgage, or if you're looking to get a mortgage, the higher the repayment, the less money in your pocket for other things like, savings and holidays and different things. So higher rates will squeeze people and will squeeze the economy a bit. If you've got a higher income, you'll have less, you'll still be comfortable, but you will have less money with higher rates if you do have borrowings. So it will make things more difficult for people. Also for people when they're qualifying for a mortgage, so they're stress tested. So if the stress test repayment is, we'll just say 1,000 a month, the banks would generally add 2% onto that. So the stress test on that might be, we'll just say 12 or 12.50 a month. So obviously if rates are higher, the stress testing is going to be higher. So you probably need to be showing more savings to qualify for the same amount than you would have before rates increased. So that's just one thing to keep in mind. Okay, the next one, the new landmark shared equity scheme. Can you break it down and give us your thoughts? So the shared equity scheme was a very good introduction by the government. So basically, if you're buying a new house, you can get up to 10%, up to 30,000 on the revenue held to buy scheme, and you can get a further 20% under the shared equity scheme. So, for example, a couple, let's say, buying a house for about 400,000, they need to be borrowing 70% to avail of the help to buy scheme. But if they borrow 70%, which would be 280,000, they can get 10% on the help to buy scheme, which would be about up to 30,000. So they'd have 30,000, and they potentially could get a further 100,000, 90,000 in the shared equity scheme. So it bridges the gap for people that mightn't qualify for the mortgage fully. So it is a very good scheme. How do you see an impact on the Irish consumer of the exit of Ulster Bank and KBC on the Irish mortgage market? Well, the less competitors in the market, the more challenging it is for borrowers. So that's not good news. So we're down probably to about 6 lenders now, 7 lenders maybe. So you have EBS, Haven, AIB, Finance Ireland, ICS, Bank of Ireland, Permanent TSB, and Avant Money. There's about 8 lenders now, whereas last year you would have had about 10. So obviously less lenders is less competition, so it's not good news. In terms of the mortgage application process, where do you see issues arise most frequently, and how can applicants of all types improve their chances of getting the final loan offer from the bank? Well, probably a couple of small things would be, if somebody's paying rent, if they're paying it in cash and it's not paid through the bank, there's no evidence of it. So the banks sometimes wouldn't allow that as proven repayment ability. So that's just a simple thing, but there's small things like that we can see in somebody's accounts before we'd submit the application and try and fix them before we'd actually make the application. Then I suppose, as I mentioned above, with rates increasing, you need to be saving sufficiently. So if you contact us, we'll tell you, look, if you want to borrow 300,000, you need to be saving 1,500 a month, or paying rent, combination of rent and savings of 1,500 a month, or whatever the figure is. We can get that in advance. So you do that for 6 months, and then the approval should be a formality. Why borrow? Well, to keep me in business anyway, I suppose. Why do I need to borrow to buy assets like my home? Well, I suppose the vast majority of people will never get their savings to a level where they can buy a property outright until they've worked for many years. So, like, if you're looking to buy a property in Cork, the price would be 300,000, 400,000 for a relatively modest home. So, most people will never save that amount of money. So, unfortunately, you have to borrow to get the mortgage to buy the house now, because it's your home, and obviously pay it off over time. Interest payments on unsecured debt can be extremely expensive. Yeah, so if you have debt, it's better to have it on a mortgage, because the rate is much lower, in and around, we'll say at the moment, 3 to 3.5%, 4%. Whereas if you're borrowing money for cars and credit cards and different things, rates can go from 7 or 8% all the way up to about 20%. So having a mortgage, I suppose, rather than other loans, is probably the lesser of two evils. Should I have loans? I don't like debt. For most, mortgage debt is inevitable if you want to buy a family home, as I explained previously. Small personal debt should be avoided or minimized where possible, or paid off when you can. So if you do need to change your car or upgrade, yes, you will need to take a loan in many circumstances. But, rather than buying the car that you take a 50 grand loan and you're paying 800 a month, try just to minimize it and, buy maybe what suits your needs. The use of credit cards should be restricted and cleared on a monthly basis where possible. So always ensure that your credit card, at least at a minimum, the minimum payment of 5% is paid every month. That's actually one place where we'd see people slip down, that some people still don't have direct debit set up for the minimum amount, and they rely on paying their credit cards manually. And one late payment can actually jeopardize a mortgage application. So make sure that you don't have to clear it every month. It's ideal if you do, but at a minimum, pay whatever the minimum your bank requires. How much can I borrow? So the bank lending limits changed on the 1st of January 2023. So the loan to value. So for first-time buyers, you can borrow 90%, so you need 10% deposit. For second-time buyers, this was different. It was 20% deposit required up to December. So now it's 10% as well. So that helps second-time buyers enormously. And then for investors and holiday home purchasers, you can borrow 70%, so you need a 30% deposit. The loan to income, again, was 3.5 times your annual gross income for everybody up to December. So for first-time buyers, as well as people who are separated and divorced, who are treated as, given the benefit of being a first-time buyer because they're starting again, they can borrow up to 4 times income. And I just have a note here that allowable income can vary significantly. So if somebody has a basic salary, say 50 grand, and if they've got commission or bonus, we'll just say of 10 grand on top of that, some banks won't allow any of that in terms of calculating the allowable income. Some will allow a portion of it and some will allow all of it. So a first-time buyer who's earning 50 grand plus 10 grand bonus, which is 60 grand in total, with one bank potentially could borrow 4 times that, which would be 240 grand. Whereas with another bank, it might only be four times the 50, which would be 200,000. So what you qualify for with different banks can vary hugely. So before your borrowing is approved, lending institution will carry out a credit check on the central credit register. So, it'll look at number of previous loans, frequency of loans, missed late payments, if loan was paid off within the agreed time frame. So as I mentioned earlier, making sure your credit card is paid on time, car loans, any loans you have, even things like, if you go to Harvey Norman's, you might get a loan there for furniture and things like that. So making sure everything you have is fully up to date. And you can get a copy of your credit report on centralcreditregister.ie, and it's free of charge. So when saving for mortgage, focus on your biggest financial priority, obviously. All surplus cash should be allocated to savings. So I'd always say to people, if you want to save, 1,500 a month, maybe put a direct debit for 1,000 a month. And then if you've got surplus cash, put that away on top of it, rather than trying to save, we'll say 2,000, maybe overstretching yourself and having to dip into savings. Reduce other expensive debt, car loans, credit cards, things like that. Now, if you do need to clear a car loan to qualify for the mortgage, we generally can get approval subject to that being cleared later. So you don't need to clear it before application. So that would also, if you owed 5,000 on a car, that would take 5,000 out of your savings. So if you are applying for a mortgage, don't clear the loans yet, but you may need to clear them later. And then consistent proof of savings required. So we need 6 months of rental payments, savings, or if a car is being cleared off, a car loan, we can actually allow that towards repayment capacity as well. Which product should I choose? Well, the main mortgages would be either a variable rate or a fixed rate. So with a variable rate, the rate depends. I suppose it's not directly tied, but indirectly, if the ECB rate is higher, if the Euribor rate is higher, the European rates, the rate you'll be paying will be higher effectively. Similar with a fixed rate, right now, fixed rates available are higher than they were a year ago. But if you take a 5-year fixed or a 7-year fixed, obviously you're fixed then for that period, so you don't need to worry about any increases. So we're seeing almost all of our clients would go the fixed rate option. Decisions to make, the mortgage rate and the bank I choose depends on, I suppose, your loan to value, ECB rates, the outlook for interest rates, how much deposit you have, whether to fix, cashback offers, and a lot more. So I suppose that's what we do at MyMortgages. We look at each situation as different, how much you want to borrow, and the best rate available for you. So making the right choice, how to choose the correct interest rate. Like, don't decide on your own bank. So if you have a bank, like, I won't name any banks, but if you have a bank with the same bank for the last 30 years, the chances of that bank being the most competitive for a mortgage are probably 1 in 8. So, we have access to about 6 lenders. So if you contact us, we can do that shopping around for you. And like, for example, one of the main banks here was the most competitive probably up to yesterday. They increased rates yesterday. So as of today, they're not competitive. Well, they are still competitive, but not as much as they were. So the advice we'd give yesterday and today could vary which bank we'd be recommending. So, you know, you need to look at the market, you know, and shop around. Switching lender. Should I switch my mortgage for lower rate? Absolutely. I'm surprised more people don't look at it. There are potentially huge savings for switching mortgages. It's very easy and can result in enormous annual savings. So some banks have reduced documentation requirement for switchers. So absolutely everybody should looking at it. And you might decide not to switch, but you should still be looking at it. Any reason why you shouldn't switch mortgage? If the rate you're already on is the best in the market, we'll be able to tell you that by seeing what you're on and what alternatives are there. And then if there's an early breakage fee coming out of a fixed rate, that potentially could be exorbitant or maybe not. At the moment, a lot of banks, it seems to be little or nothing. But again, without reviewing it, you don't know that. The mortgage process beginning to end. So there's the inquiry stage. When you're thinking about it, you call us. We'd urge everyone to look at the life cover because having life cover is a requirement of a mortgage. And if you can't get cover for some reason, then you won't be able to get a mortgage. You submit your documents to us. We'd review the documents, see which bank, then we'd submit it to the bank. It goes through, there'll be some queries back and forth generally. Then it'll go to the bank's underwriting department. They'd make the decision. If it's approved, you get your approval in principle. And then once your sale agreed, you move from approval in principle to loan offer. Once you got your loan offer, we get the valuations done and the home insurance and a few other bits and pieces. And then the loan offer is completed and then funds withdraw down. So it all sounds fairly simple there, steps 1 to 10. So generally, you know, banks can be slow. It can be, you know, challenging. Trying to find the house is probably the hardest part of it. But that would be the process of it anyway. Okay, so that's the slides. I'm not sure was I a bit quicker than I thought there, but thank you very much for attending the webinar and pat yourselves in the back as you've completed your wellness course in mortgages. But so David, any questions there? I'd be delighted to try and answer them.
Yeah, great. Listen, thanks very much for that, Joey. And yeah, actually, to be fair to you, thanks very much for sort of keeping it as simple as you can, because I think, to be fair, the last slide there in terms of all the steps, you know, I suppose there's a lot involved from end to end in terms of when you start to look to get it, to actually get it. So it's probably, you know, you made it sound simple there in some ways for us, which is probably good, because I think, and even in terms of mortgages, is something that we all either have or hope to aspire, you know, for much sort of younger members. So something we do want to get. And it's a pity you weren't around when I was getting mine. I just in terms of going around and seeing who's in the market, I just recall just going into the bank's office and signing up documents. I don't recall even looking at different options and stuff like that. But anyway, I'm kind of stuck with it now. So, so thanks very much for that. Yeah, just one or two questions have come in here. Just one, you touched there about, you know, the first-time buyers and maybe second-time buyers and, you know, 4 times earnings and whatnot. Just for, I suppose, for a self-employed person, because obviously their income could be up and down over the years. What should they be doing, or how would they look at?
Yeah, so for somebody self-employed, and you've got accountants on here, obviously they've got a lot of clients that are self-employed. So we look at the last 2 years average. So if somebody's got taxable income in, we'll say 2020 of 40 grand and 2021 of, we'll say 60 grand, we take a 2-year average. So in that example, it would be 50 grand. So that would be the allowable income for that person. So what's actually interesting is that obviously the tax return for 2022 isn't due yet until next October.
Mm-hmm.
So if you have a client who's self-employed and if you did their tax return now, so let's say they 40 grand taxable income in 2020, 60 in 21, and let's just say if it was 80 in 2022, we take an average of the last 2 years. So 60 and 80, the average would be 70 versus 40 and 60, the average would be 50. So they could borrow, instead of 200,000, they could borrow 280. So it's worth filing the tax return early to maximize the income, assuming that there's an upward growth in the taxable income for the person, you know.
Okay, thanks for that. And I suppose just in general terms too, even maybe before people come to talk to you, or like what should they be doing, or what information, or what are the common pitfalls just around, or what do you see when people do come or to you?
Well, probably, you know, saving enough and documenting your saving. And sometimes people have exceptional expenses, like if you did work in your house, or if you had education fees, or maybe medical expenses that, anything you incur that's out of the norm, documented, keep receipts. And if we can say, look, they don't have any savings, but look, they changed their car and they paid out $5,000 cash or whatever, we can kind of work it back that way. But I'd say at the earliest convenience, if you're thinking about a mortgage at all, just pick up the phone, give us a call, and we can talk through, and give you the pointers. And then the benefit of that is that 6 months' time we're making your mortgage application, it's seamless rather than, trying to answer all these queries from scratch,
Yeah, because I get the impression, I say, once you start the process and stuff like that, I suppose in the sense that a lot of the hard work needs to be done before you actually, submit the application to the different providers. I suppose just one community, just a general around property prices. What's your view on that, or what the property market generally?
I think I'd probably see prices sustaining where they're at. There's an undersupply, there's a strong demand. That there is a cost of living crisis and all that, but generally people are employed. There's strong wages out there. There's good demand, especially around Cork and city, urban and rural. And there's a general shortage, so I can't see prices coming down.
Okay,
I'd say to people, if you were thinking about buying, if the alternative is paying rent, the rents are so strong. You could be paying 1,800, 2,000 rent, no problem.
Yeah.
And like to borrow 300,000 over 35 years, even at a rate of, we'd say 5%, would be roughly just over 1,500 a month. So if you're buying, you're generally paying less than you would be on rent.
Okay.
So if you're thinking about buying, I'd be, obviously you want to do the best deal you can and pay as little as possible, but I wouldn't be waiting for prices to fall and then buy, because that might not happen.
Yeah. So I suppose you're better off with it. Paying, I suppose, down some debt for an asset you'll have yourself in the future, as opposed to paying dead money in terms of the rental income and stuff like that. And just in terms then of mortgage approvals and stuff, are they still happening at high levels, and there's no kickback there from different institutions, or slowdown in processing, or rejection, anything like that?
The last couple of years, some banks would be slower and some would be quicker, and it swings and roundabouts. But generally speaking, the banks are open for business. They are lending. They will want you to see a little bit more savings to demonstrate repayment capacity. But overall, the banks are open for business and we don't have any issue getting approval.
Okay. Another question just come in there around self-build mortgages. Any sort of general advice around that? Or?
Yeah, well, with self-builds, a lot of self-build people are gifted a site, maybe on their home place land. And if you've a site gifted, and let's just say it's worth 50 grand, then that would count as your deposit. So technically you could borrow 100% of the build cost. You actually don't need any savings. So if you're receiving a site by gift, that's a benefit. If you're buying it, then it's 90% of the site is what we can borrow and 90% of the build cost. Also, the Help to Buy scheme, the Revenue Help to Buy scheme, is available for people building. They can claim up to 30,000 under that scheme. Then as well, if you are getting planning and incurring any fees, or planning fees, architect's fees, keep receipts of all of those, because again, somebody mightn't have savings, but they might have paid the architect $8,000 to get planning. So just keep any receipts, anything that you're paying out in relation to the planning or the build. Okay,
great. There's a couple more questions in here, and if anybody else does have any questions, like you said, then you can just pop it in there to the Q&A bit or the chat box. Just another question here. It's in respect to a client. For someone in their middle 50s who is divorced and renting but wants to get a mortgage, can you get a mortgage to take them past the age of 70?
No, 70 is the max.
70 is the max, okay.
Yeah, so
okay.
15 years, if they're 55, 15 years would be the maximum term in that example.
Okay. Then just another question here. It's around life assurance. You're saying obviously life assurance is a must. Are there any exceptions around that? So, for example, if the loan was a small amount of around 100,000,
the banks have discretion. It's up to them to decide if they'll waive that or not. If somebody can't get life cover, and if they're borrowing 100,000, and let's say they've got death benefit and service, if they're working with Apple, for example, and if they die, they might get a payout. We'll just say 200 grand. On a case-by-case basis, the banks can decide to waive that, but there's no requirement on the banks to do so. And we'd be urging people just to have it. If once you can get the policy, have it, and you've got that condition boxed off then.
Great. Okay, so they're all the questions that have come in. So thanks very much for answering those, Joey. Listen, thanks again, Joey, for taking the time out to come to us this afternoon and share all your thoughts and insights. And thanks again to you for offering up the copy of the book. Do you want to just outline the email address again, just for that, if anybody wants it?
Yeah. So the book, info@MyMortgages.ie. And if anybody's got any queries, mortgage or financially related, send us an email on that, MyMortgages.ie, contact us, and we'll give you the best advice we can over the phone or by email.
That's great. Listen, thanks very much again, Joe. We appreciate your time. And
thanks, Dave.
Not at all. And just before we go, folks, thanks very much for you all for joining us this afternoon in such big numbers. And please feel free to reach out to Joe if you have any mortgage related questions, regardless of what age you are. He'll be happy to help you out. I suppose again, just if there are any sessions or anything you'd like to see us running in the future, please do reach out to Fiona, let her know, because we're very keen in the Cork Society to engage with our members and provide them whatever they'd like, such as sessions today and the ones we've had over the last couple of weeks. And if there's anything else you'd like to do, please do reach out. We have 2 more sessions to go. The next one is next week, Wednesday, and it's actually a colleague of mine giving that, Sheahan McNamara, who's a solicitor, and that's just going to be around just looking at some legal aspects and considerations that we should all consider as we go through our life journey. So finally, thanks again this afternoon for joining us. We probably finished a little bit earlier than anticipated, but you have an extra lunch break before you get back to the work in the afternoon. And as always, do feel free to reach out to Fiona with any suggestions you might have. So with that, I'll say goodbye and thanks again, Joey. Take care, folks. Thank you.